Hello and welcome to Real Commercial Propcast, the commercial property podcast where we look to answer the most common questions for anyone on the commercial property journey, whether you're an investor, business owner, or somewhere in between. The topics we discuss are of general nature only and don't consider your personal objectives or financial situation, so it's always best to obtain independent advice before making any commercial property decisions. Hey there, I'm your host Tessa and I'm the head of product at Real Commercial Australia, and my co-host is with me again. That's David Story, who has spent many years in the commercial property industry working across all asset classes in marketing and communications. David, hello.
Hi Tessa, we were off to a great start last week when we covered our opening topic of should I invest in commercial property, and hopefully many of our listeners are now keen to start on that journey. But there's still a lot to learn throughout the series. So for our second episode today, what are we talking about and who's our guest expert?
Yeah, well, now that we know some of the benefits of investing in a commercial property, today we're exploring the different types of commercial property that you could invest in. So on realcommercial.com.au, we list everything from offices and warehouses through to hotels and farms. Basically, if it's got a commercial use, we'll probably list it. So to help us explore these different commercial property types, our guest expert today is George Davies from Colliers. George is a leader within the Colliers Melbourne City sales team and is a specialist in the sale of Melbourne CBD and city fringe commercial property. He focuses on the strata office and retail markets, and along with his colleague Anthony Kerwin, in 2021 he was responsible for a 92% market share of all strata office properties to transact in the Melbourne CBD. That is a super impressive stat, so it must mean that we're in good hands today. So hello George, and thank you so much for joining us today on the Real Commercial Propcast.
Thanks very much for having me, Tessa and David. I'm excited to be here.
Oh, yeah. Good morning, George. Great to have you with us today. Obviously, your track record certainly makes you the perfect person to help us with today's topic of what sort of commercial property should I invest in. And as we mentioned before, many of our listeners are just starting out on that journey. So can we just start by asking you to share with them, what the different types of commercial property are, and maybe the benefits of each by aligning them to different investment strategies?
Sure, thanks David. There are many layers to that question and we could sit here for quite a while tackling it, but I'll provide a high-level overview. The most common types of commercial property are office, retail, industrial, hotels and land. Today I'll focus on the first three. Office is typically used by professional service providers and have historically been one of the better performing commercial asset classes when weighing up risk and return. The benefit of office investments is that they are typically characterised as attracting medium to long-term tenants. For example, the common lease for a residential property is 12 months. An office lease is typically 3 years minimum, which provides owners further security and reduces any vacancy risk. The second asset class is retail, and retail can be broken down into many sectors, including hospitality, fashion, entertainment, medical, and so on. Each sector has its pros and cons, but for retail property as a whole, they typically attract higher rents than other commercial asset classes. For example, Swanston Street in the Melbourne CBD, a shop there could attract rents of circa $3,000 per square metre, whereas an office 1 or 2 levels above may be receiving $500 a square metre. So there's a huge difference. Thirdly, industrial property. Industrial assets are classified as property used in the manufacture or storage of goods, so factories, workshops, warehouses, etc. The benefit of industrial properties, generally they provide higher returns than other commercial asset classes and are again associated with longer lease periods due to the specialised nature and fit out of the facilities required by the tenants. Does that answer your question?
Yeah, that was an awesome breakdown, George. Thank you so much. And there's so many different commercial property types out there. And, those are just scratching the surface. You got all the other types such as childcare and hotels and farming. So, yeah, it is really such a wide variety of options, or asset classes, as we sometimes refer to it in the commercial world. But so once someone has narrowed down the type of property that they're looking for, it can still be fairly overwhelming if the property that they're looking to purchase is vacant. And so the process of needing to find a secure and reliable tenant with a solid business to lease it to can be quite daunting. So another term that many investors will come across is a tenanted investment. So can you firstly help us understand what a tenanted investment is, and then some of the benefits of picking one and maybe some of the things to look out for?
Yeah, definitely. A tenanted investment is essentially an income producing asset. So to put it as an example, which is always easier to understand, if you own a shop and it's leased to Hungry Jack's will be paying you rent to use your property. So that's ultimately what a tenanted investment is. On the other hand, if you're a business owner and you purchase a property to use it for yourself, that's an owner-occupied asset. The pros and cons of a tenanted investment really differ based on whether you're a passive or active investor or an owner-occupier. Passive investors have little to no involvement in managing the property. They sit on an asset and just watch the rent hit their accounts each month, whereas active investors take a more hands-on approach and are looking for ways to add value to their asset. And this can be done through increasing the rent, undertaking capital works, etc. But as a whole, the benefit of a tenanted investment is that if you're an investor and it's tenanted upon purchasing, then once you settle the property, you instantly start collecting rent, and that rent can be used to pay back the mortgage or in other ways. The cons with a tenanted investment: if you purchase an investment and the tenant is paying below the market value in terms of rent, you need to wait until the rent review period to increase it. Secondly, some tenants can be quite demanding or unreliable, and therefore the management of a property can be quite onerous. For example, if the tenant stops paying rent or doesn't pay on time, there's a lot of different factors to weigh into it.
And George, can I just jump in there? So with a tenanted investment, would an investor usually be expecting to pay a slightly higher premium on that property if there's already a secure tenant in that property? Or is it kind of the same whether it's a vacant property or it's tenanted already?
Yeah, good question, Tessa. It all depends on the lease, how secure the lease is. So, for example, if it's a 5-year lease to Hungry Jack's, that buyer is going to be required to pay more of a premium than if it was a 3-year lease or even a 1-year lease. So the longer the lease term, generally speaking, the more the buyer will be required to pay. But if it was a vacant property, you don't necessarily base the value of that property on the lease because there's no lease. You base that property on a mix of, it might be the land rate, the building rate, and what you could potentially lease the property out for. So there's a lot of factors to weigh up in coming up with a valuation on the property.
So George, we've covered different asset classes, we've considered tenanted investments, but I'd like to cover off on land value as well as a consideration. You know, there's a common misbelief that a property generally goes up in value, but it's not that simple, is it? Can the building on that land depreciate? And is it the land which usually boosts a property's worth? You know, for example, you're in Melbourne, so, parts of Melbourne that were once industrial areas close to the city are now full of apartments. And due to the rise in land values, those properties lend themselves to redevelopment to capitalise on that higher value of land. So if I'm considering whether to buy a commercial property, does the type of tenant matter? Is it the asset class that I should focus on? Or should I be considering land value as well?
To break it down, I think it really depends on what kind of investment strategy you're looking to follow. For example, if you're a retiree and you're looking for consistent cash flow, you might look at a property that's secured by a long-term lease and provides steady returns. You don't necessarily have an appetite to be actively trying to add value to that asset. Whereas if you're an active investor and you're looking to buy a property and are actively trying to seek to improve the value of the asset, which might be done through refurbishment works, releasing, etc., then you probably don't want a long lease term. You may prefer something that's vacant. And then in terms of your question regarding where the value of a property lies, whether it's in the land or whether it's in other areas, it's not that simple. For example, let's take a single level warehouse in Collingwood. This area is gentrifying and council is supporting both residential and mixed use projects. The value of this site may be in the land, as you can knock over the existing warehouse and create 10 levels of apartments or office on top for argument's sake. Then once you develop that site and you have 10 levels of office space, let's say you buy level 8, the value of that property on level 8 isn't in the land value, it's now in the building value. So the way that works is a tenant pays you a set amount of rent based on how much building area there is. And then once that rent has been achieved, the value of that property is based on a return.
So to wrap us up for today, George, let's imagine you were investing in commercial property for the very first time today. What sort of commercial property do you think you'd pick to generate the best returns? i.e., what would be the perfect introduction for our listeners to start their commercial property investment journey?
For me personally, I think the retail market poses some significant opportunities. I like the look of some strip retail, perhaps a shop that's become vacant through COVID, and I can get in there, do some refurbishment works, add some value through CapEx, and find the right tenant for the space. Particularly if it's also got a residential unit on top, I think having a diversified income through the residential unit and the ground floor retail, it ultimately diversifies your income and gives you a bit of added security as well if one of them left.
Yeah, no, that's really, really good pointers there, and really interesting to think of the mixed use space as well. But that wraps us up for today, George. So thank you so much for coming along and educating us about all the variety of different commercial property types and for the deep dive in tenanted investments. I've really enjoyed our chat today, so thank you.
Thanks very much, Tessa and David. And if any of your listeners want to reach out, I'm more than happy to take a call to discuss how we can assist in finding the right asset for them.
Perfect. So if you're hungry for more information on commercial property, you can check out our news section on Real Commercial, which I'll link in the show notes below. It's got a great range of content from guides and advice through to recent news and happenings in the commercial space. So do go check it out. There's a lot of great content there. But otherwise, thank you for joining us for another episode of Real Commercial Propcast, brought to you by the #1 address for commercial property, realcommercial.com.au. Don't forget to subscribe wherever you listen to your podcasts so that you never miss out on a new episode. Catch you next time.